The financial crisis that has roiled markets in rich countries is now hitting developing countries hard. Banks are at risk, many currencies are weak, and foreign investments are down. World Bank analyst Hans Timmer says countries that performed strongly last year are seeing record declines.
Our forecast is for a 4.5% growth in the developing world. That still seems high, but it is more than 3 percentage points lower than only in 2007, and that is one of the sharpest declines in growth on record.
The decline is blamed on weaker demand from developed countries. That has resulted in a slump in global trade, the first in 25 years. Less trade means losses in manufacturing and export markets, which in turn have led to growing unemployment.
Slower growth means slower income growth also for everybody in the developing countries, including the poor, and higher rate of unemployment in developing countries. That means that the benefits that we have seen over the last 5-6 years with record growth in developing countries will be on hold for a short period of time.
The report says developing countries in sub-Saharan Africa will enjoy faster economic expansion than most industrialized countries next year. But many countries in Africa and East Asia will face difficulties raising money as credit tightens around the world. Bank economist Andrew Byrne says countries that rely on profits from oil and metals will fare better.
The positive story there is that when we observe what commodity exporting countries have done over the last 20 years, they've been much more prudent in terms of the management of the windfall revenues that they've received as compared with the 1990s or the 1980s.
Although the recent decline in oil prices has resulted in lower energy and food costs, Byrne says poor countries will need help from rich countries to survive the economic fallout. The World Bank has not ruled out the possibility of a global recession, but the report says the worst should be over by 2010. Arcega, VOA News.